In early 2026, thousands of ordinary investors tried to pull their money out of funds that were supposed to be the boring part of their portfolio. And a lot of them got the same answer. Not right now. Maybe later. Across the industry, people asked for more than $13 billion back, and only got about 2/3 of it. So how does boring and safe quietly turn into, you can't have your money? To understand that, you have to understand the thing all of those funds are actually built on. It's a word you hear constantly and almost never get explained. Credit. Let's start from the bottom, because this word gets thrown around like everyone already agrees on it. Here's the one question sitting underneath all of it. If you lend someone money, will you actually get it back? For almost every borrower on Earth, that's a real worry. But there's one kind that never has to sweat it. The kind that makes the very money it owes. When the US government borrows dollars, it's also the one that creates dollars. If a payment comes due and the cash isn't there, it can just make more. It can't be forced to come up short. So when you lend to Uncle Sam, you're barely asking, will I get paid back? You basically will. You're only asking, what's my interest rate? On Wall Street, that world even has a name: rates. There's one famous asterisk here, though. Back in 1998, Russia owed a mountain of debt in its own currency, the ruble, money it could print at will. And it defaulted anyway. Why? Because printing enough rubles to cover it all would have torched the currency and set off runaway inflation. Russia decided that simply breaking the promise was the least bad option on the table. So can print doesn't guarantee will pay. But cases like that are the rare exception, not the rule. Now look at everyone else. You can't print dollars. Neither can Apple, or your local restaurant, or some giant company you've never heard of. They have to go out and earn every dollar they owe, sell something, turn a profit, bring in cash. And if the business stumbles, they can run short and leave you hanging. That possibility, the honest chance you don't get your money back, is the whole idea of credit. Lend to something that prints its own money and its rates. Lend to anything that has to go earn it and it's credit. Almost everything is credit. And here's the scale of it. Of the roughly $73 trillion in the world's major bond markets, more than half, around $45 trillion, is credit. In other words, most of the world's lending is the risky kind, where the borrower could come up short. So who's on the other end of all these loans? A lot of it is the public stuff you'd expect. Big companies like Apple raising cash by selling bonds that trade on a market, kind of like stocks. There's a live price, and if you want out, you sell. But the fastest growing corner is the opposite of that. It's called private credit, a loan that never goes up for sale. Instead of borrowing from thousands of investors, a company gets its cash directly from a single fund on custom terms hammered out in a back room. No public price, no exchange. The fund just holds the loan and collects interest until it's paid back. Or isn't. And here's the twist most people miss about who's borrowing. You'd imagine this money flowing to factories and family businesses. Mostly, it doesn't. More often, private credit is lending to private equity firms so they can buy up mid-sized companies. The loan funds the takeover. It's finance lending to finance. This barely existed 20 years ago. Today, it's about a $2.3 trillion industry, and it's expected to roughly double in the next 4 years. Okay, if the whole game is guessing who pays and who doesn't, how do you actually guess? That's the entire job of the credit rating agencies. At the end of 2023, the three big ones employed more than 5,000 analysts, and their only task is to rank, as precisely as humanly possible, how likely each borrower is to default. The top of the scale is AAA, the safest. The bottom is CCC, hanging on by a thread. Cross a certain line and you fall out of investment grade and into what the marketing people call high yield, and everyone else calls junk. As you move down the scale, AAA, AA, single A, and so on, the share of companies that default doesn't just rise, it rises exponentially. The agencies can tell the difference between a borrower with a 0.7% chance of defaulting over 10 years and one with a 1.0% chance. That's a fine slice, and they mostly get it right. But, and this matters, defaults don't show up politely, one at a time. They come in clumps. Europe learned this the hard way. In the boom of the late 1990s, a young crop of telecom and cable companies borrowed enormous piles of junk-rated debt to wire the continent with phone lines and cable networks. Then the dot-com bubble burst. The customers and the cash never showed up, and the whole sector went down like dominoes. Giants like the cable operator NTL and the fiber network KPN Quest collapsed into some of the biggest bankruptcies of their day. By 2002, more than 80% of Europe's cable debt had defaulted, along with half of its telecom debt, enough to drag down over 40% of the entire European junk bond market in one stretch. Diversification only saves you if you're actually diversified, and here, a whole young market had piled into the same corner. So if these borrowers might not pay you back, why lend to them in the first place? One reason, they pay you extra. That extra slice, the amount above what a money-printing government pays, is called the spread. Think of it as hazard pay. Here's what that looks like. Lending to the US government for 5 years might get you around a 3.8% yield. Betting that Apple survives the next 5 years, pretty safe bet, pays you maybe 1/3% more. But lending to a riskier company like the cable giant Charter Communications, that pays almost 3 full percentage points more. If you're confident Charter makes it, that spread looks an awful lot like free money. And over long stretches, it basically has been. If you'd spread your bets across a big, diversified pile of corporate loans and held for 7 years, you'd have beaten government bonds almost every single time. In fact, the data suggests that, on average, most of a credit spread is pure profit. You get paid far more than the actual defaults end up costing you. Which raises the obvious question. If it's that reliable, why hasn't everyone piled in and competed that free money away? What's the catch? Here's the catch. That profit isn't free. You're being paid for something. You're just not being told what. You're being paid for liquidity, or really, the lack of it. The ability to get your money back exactly when you want it. In calm times, you never notice. The loans sit there, the interest rolls in, everything's fine. But when fear hits and everyone wants out at once, there's no one to sell to. And you can watch this happen in real time with bond ETFs, funds that bundle up corporate debt and trade on the stock exchange. Look at the 2008 crisis. If you tried to sell a junk bond ETF on October 10th, the market would have handed you 91 cents for every dollar of bonds inside it. 9 cents gone, just for the crime of wanting out that day. That's the whole secret. The spread that looked like free money was actually rent. Rent you collect for agreeing to be trapped. And the bill only ever comes due at the worst possible moment, all at once. Which brings us back to those investors in early 2026, standing at the door asking for their money. Remember the cockroaches? Late in 2025, JP Morgan's CEO Jamie Dimon warned that when you see one bad loan surface, there are probably more, like spotting a single cockroach in the kitchen. Sure enough, they kept crawling out. A couple of fraud-tinged collapses in the US, a British property lender that imploded owing billions. Very things that make credit so lucrative, that it's private, that it doesn't trade, that nobody quotes you a daily price, are the exact things that make it dangerous the moment the story changes.